Hello, Dr. Tim Creel here. Going to take a look at Chapter 10 of Auditing. Let me go ahead and pull up the screen and start the presentation. Okay, so Chapter 10 looks at the finance and investment cycle. And as you've seen in the last few chapters, we've been breaking things out by cycle. And they do that, and of course, in auditing, you do that because there are related areas. Like we looked at the revenue and collection area, revenues and receivables, those are related areas. So if you put them together, then when you're auditing one, you're really almost auditing the other. So it improves the efficiency of your audit. So this is the finance and investment cycle. So this would be, how does a company finance their growth and how do they handle their investments? How do they account for their investments? So this slide right here is a good slide because it kind of summarizes everything you do in an audit. And basically you can apply it to every one of the cycles that we've gone through. So this is like the big picture of auditing right here. So you would plan the audit during the interim period, which would be, sometime after you finish last year's audit and before the end of the year. That's the interim period. During that period, you're planning. If you can rely on their internal controls, you can do some interim testing throughout that time. So that's when the audit planning for the next year begins. Okay, so learn the cycle. And so you would want to learn what makes up the finance and investment cycle. And a lot of this occurs at audit team meetings. Remember that audit teams are required to have regular meetings where they go over things like this. They discuss things like this. They ask questions. They look for areas where fraud could be present or where there could be problems and talk about it. And those are required team meetings about different aspects of an audit. They perform a risk assessment. In every cycle, there are areas that are the greatest risk of fraud, the greatest risk of misstatement. And this is what you do. You assess risk. Where are the areas of greatest risk? Where's the areas of the lowest risk? The assessment of internal controls. Again, you're looking at internal controls for two reasons. One is because you are performing an audit on their system of internal controls. You're gonna sign off on the effectiveness of their system of internal controls, just like you are the financial statements that they follow GAAP. So you're doing that by the assessment of internal controls, but you're also looking at how much can internal controls be relied on as part of the financial audit. So it's very much a dual purpose with your assessment of internal controls. You look for the proper separation, and this kind of goes under internal controls, but you look for the proper separation of duties. You look, is there physical control of assets? Independent verification or others like internal audit coming back over and checking things. Um, you assess controls by inquiry, which means you ask questions. Remember what I've said, trust but verify. So if you ask a question, they give you an answer, you verify their answer. You don't just take it verbatim. You don't just take it as, oh, well, okay, that sounds good. You verify it. You observe. You observe certain things occurring. You examine documents, vouching and tracing from the financial statements back to the source document, tracing from source documents back to the financial statements. So vouching and tracing. You retest data, which means that sometimes you follow data through to make sure that it's doing what it should do, to make sure if there's any controls that should stop certain things are working properly. And walkthroughs, again, are kind of, more like running test transactions or, um, following something again through, kind of similar to, in some ways, to retesting the data. You also might put in here reperformance, like you might reperform a bank reconciliation, for example. And all these are things that we've talked about, and they would be used in this cycle just like they would all of the other cycles that we've discussed. You would determine materiality. Okay, what's material for this audit? And that would also apply to the finance and investment cycle. What's material in regards to transactions in this area within this cycle? You would run substantive tests. You would do confirmations. You would recalculate numbers to make sure that the numbers were calculated properly, like interest, for example. You would confirm balances with third parties, outside third parties. Dual purpose tests, these would be tests that not only tested the effectiveness of controls, but also basically helped with the financials as well. Again, kind of killing two birds with one stone. That would be kind of a dual purpose test. Okay, so the finance and investment cycle, it starts with financial planning. You sell stock or you borrow money. The acquisition and expenditure cycle, production and payroll cycle, revenue and collection cycle. Kind of similar to these would have been the other cycles that we looked at. But it basically starts again. This one starts with sell stock or borrow money. And some of it is based on the other cycles though. Because think about it this way, if you want to if you want to acquire another company or acquire a certain technology, takes money to do so. You need to sell stock or borrow money. If you are producing, if you want to produce more product, it's going to take more money. If you want to increase payroll, if you want to, so pretty much something in every one of these other areas kind of ties back to the finance and investment cycle in a way. And again, notice how it fits with others. I was jumping ahead of myself. Notice how it fits with the other cycles. It helps provide the funds for a company to operate. Now, it starts with a capital budget. If you remember what capital budgeting is where you're really planning for long-term asset purchases. Many aspects of this may be handled by outside third parties. So many aspects of this cycle, may be handled by, registrar or trustee to hold certificates. So if you're investing in another company, the stock certificates would be held by a registrar or a trustee typically. Periodic reconciliation is what is held the same as what the company is showing. And this would be something that the company would do, but then as an auditor, you would verify this. Authorization. Many actions must be authorized by the board of directors. So one of the big things you would look for as an auditor is the authorizations. If transactions must be authorized by the board of directors, you would check the board of directors minutes to see, did the board of directors authorize these transactions? Only high-ranking employees should have access to any negotiable certificates held by the company. This would be very much more of a physical control. Looking at who has access. Are they held in a vault, or even with the trustee, who has access to them? And that's a physical control related to these. Now, significant accounts and relevant assertions. Management assertions for investments would be existence and occurrence. Do they exist? Completeness, valuation. Are they properly valued? Presentation and disclosure. Are they presented and all relevant information disclosed in the financial statements? Long-term debt, existence. Does it occur? Does it actually exist? Completeness is everything related to it shown. Valuation, is it properly valued? Presentation and disclosure. Capital stock would be completeness, presentation and disclosure, and retained earnings would be completeness. So you would look at the risk of material misstatement. Where is the risk of material misstatement greatest in all of this? A list of difficult to value assets, derivative instruments, intangible assets, and pensions. Now, one thing I'll say about this is for some of these assets that are difficult to value, this could be an area where you need to bring in an outside specialist, an outside expert. Remember that there are times in an audit where the auditor should bring in outside experts to verify something, especially in an area where where no one on the team has the ability or to do so, because that's the only way you're going to get proper valuation. such as I might have given the example earlier. I've given this in class before. What if you were auditing a jewelry store? You probably want to bring in a financial expert to look at the diamonds. Are the diamonds the value that they say they are? Are they the quality that they say they are? And most accountants would not know that. But you bring in an outside specialist, a jewelry expert, then that would be a time to bring in an expert. This might be a time to bring in an expert as well. Lease accounting. All leases greater than 12 months must be recognized as assets with matching liabilities. Again, this would be something you would be looking at to make sure that this is being followed on the financial statements. Loan covenants. This would be anything that's related to a loan, like if you've got to keep a certain current ratio, if you've got to keep a certain amount of money in the bank, then you would need to show that this has properly been recognized on the financial statements or in the notes to the financial statements. Disclosure has taken place as to this covenant, and the covenant's being followed. Like I said, loan covenants could be something like in order to keep this loan, you have to keep a certain current ratio, the company does, or they need to keep a certain amount of money in deposit on at a bank. Those would be examples of loan covenants. Impairments. Um, Taken as losses when they occur. Remember that impairments is whenever you look at the value of something like goodwill or certain long-term or certain, certain assets, and you look at has their value decreased? And if their value is decreased, then you're going to write down that value. That happens a lot with intangible assets, some with certain intangibles, goodwill being the main one there. And sometimes, like I said, with long-term assets as well. And so basically, they would be taken as losses. Now, one thing to do is to watch for the big bass. And what I mean by that is this is something auditors have to watch for. And that is that in times like when companies are going to take a loss anyway, they go ahead and take a big bath, go ahead and impair the value of a lot of their assets to where they won't have to do this in future years. Because if we're already going to lose, it won't hurt us near as bad now as it would in future years. So watch it that they are not taking too much for impairments, which would be the big bath. Presentation and disclosure, you would want to make sure that you remember the different types of investments from intermediate, held to maturity investments. These would be investments that the company wishes to held to maturity. This would be investments in bonds. Available for sale. These would be investments that within the next couple of years, the company intends to sell. And trading securities, these would be the shortest term investment. These would be investments that within the next 90 days, the company intends to turn around and sell. The company would classify these based on their intentions. What you as the auditor would look at is everything presented properly here? And are they basically put in the right place? Are they, if a company's accounting for something is available for sale, making sure, I think the best terminology would be making sure that the company has the ability to do what they say they're going to do with these. And that would be one of the things you'd be looking at as an auditor. Are things classified properly in these areas? And internal controls, again, related to this area. You'd look at the board minutes from the minutes from the meeting of the board of directors. That's again, talking about it earlier, that's a big part of authorization because the board of directors must authorize many of the transactions from this area. Physical controls, like making sure that limited access to certificates, that stock certificates from investments in other companies. A separation of duties, making sure that there could be, different people. Like, for example, if the CFO is, has the ability to do certain things, making sure that, I'm trying to think of a good example. Like that there's certain things that the CFO can do, but then there are other things they can't do. Certain things the controller can do, certain things that they can't do in regards to this area. That's probably the best way to describe it. And then financial experts on the audit committee, making sure that you have at least one financial expert on the audit committee. Compensating controls reduces risk to a missing control. Kind of an example of, and what this is especially in small companies, you see this done a lot, compensating controls. Like if you're in a really small company, you might not have the ability to properly put in place separation of duties. But a compensating control would be that maybe the CFO, the CEO, the owners of that small business would be more involved in checking more things as kind of a compensating control. A compensating control here might be, for example, what if the CFO handles transactions, but what if then a notification is sent to the board that this transaction went through to kind of keep the CFO in check from going rogue? So the board could see, okay, we authorized this. Here's where it was done. We authorized this. Here's where it's done. If something came through without authorization, the board would know that the CFO's gone rogue. That's kind of a compensating control. Test the effectiveness of controls. Review minutes from the board of directors meeting. Inspect documents, especially related to authorization. Inquire about separation of duties and lockbox security procedures. Control over accounting estimates, depreciation, valuation of financial instruments, accruals, leases, losses on segment disposal and business restructuring. These would be areas where estimates would be part of their valuation and how they're shown on the financials. Here's the main thing you would be looking at as an auditor. Our estimates, are they reasonable? Are they reasonable? If they're not reasonable, you would have to question what's the meaning behind it. If they're not reasonable, then again, that's something to really question as an auditor. If they're reasonable, that's the main thing you're looking at in terms of estimates. Authorization, review minutes of board of directors meetings. We've said that a couple of times. Record keeping, control over recording the transactions, who records the transactions, and custody, who holds the stock certificate books. These would all be things you would look at as an auditor in terms of internal controls over things within this cycle. And then substantive tests. Of course, substantive tests are the tests you run to verify your conclusions. Examples include market values of marketable securities, do confirmations outside with investments with brokerage firms that hold the investments, vouch purchases and sales of securities. You would be, following it through, um, from source document to the financials or financial statements to the source documents. Physically inspect all securities held by the company. So if the company says they have this much, you would actually set up an appointment with the company's permission to go and to count and to see, do they have everything that they show they've got? Because if they have an investment, they would have the actual securities. Vouch interest income. You would kind of this is kind of where you would do kind of a recalculation a lot of times, and confirm long-term debt with debtors. So you would look at, you would contact debtors to verify that long-term debt actually exists. So this would be like a confirmation with a third party. Hedging instruments, very complex. Again, might be a case to bring in an outside specialist. Confirmations for notes and bonds payable. You would confirm these balances with the outside sources. And auditors should examine minutes from board of directors, proxy statements as well. These would be related to stock issuances and offering registration statements. These would be things because there are certain requirements of information that they have to put on there. And one of the things you'd make sure is that that information matches the financial statements. That'd be something you could look at there. Okay, that is chapter 10. Thank you and have a great day. Bye-bye.